Marcus and Rosa started on the exact same Tuesday. They were the same age. They each had $20,000 and both wanted to become millionaires someday. Marcus treated investing like a second job. He downloaded every finance app, turned on market alerts, listened to podcasts during breakfast, read headlines before bed. When stocks fell, he sold. When they rose, he bought more. Over the years, he made hundreds of trades and checked his account almost every day. Rosa did something that sounded almost lazy. She put her $20, zeroed it into one simple fund, set up a small automatic transfer from her paycheck, and then stopped looking. No alerts, no trading, no market predictions. In fact, she barely opened the app again. 40 years later, Rosa had more than $1 million. Marcus had only a fraction of that amount. He spent decades worrying about his money. She spent decades living her life. Marcus watched his investments every day. Rosa never looked once. And here's the surprising part. This wasn't luck. It's exactly what the math guarantees. In the next few minutes, you'll see the simple math that can turn $20,000 into $1 million. The exact accounts and order to use in 2026, and the one hidden reason most people never reach that goal. The idea sounds backward, but the evidence is clear. Checking your investments less can actually help you earn more. Even Warren Buffett believes this. In his will, he instructed that most of his family's money be placed in a simple index fund. And by the end of this video, you'll understand why some of the highest returning investors ever recorded had one strange thing in common. They forgot they even had an account. Section 1. The reason Rosa's story sounds hard to believe is because our brains are not built to understand compound growth. We see $20,000 and think, that's nice, but it's nowhere near $1 million. What we miss is that money can grow on top of money. Imagine rolling a small snowball down a hill. At first, it barely changes. But as it gets bigger, it starts picking up more snow with every turn. Eventually, the growth becomes hard to believe. That's exactly how investing works. If $20,000 grows at about 10% a year, it becomes roughly $40,000 after 7 years. 7 years later, it doubles again to about $80,000. By year 21, it's around $160,000. By year 28, it's about $320,000. Around year 36, it reaches roughly $640,000. And somewhere around year 42, that original $20,000 crosses the $1 million mark. No extra deposit required. Just time doing the heavy lifting. There is a simple shortcut called the Rule of 72 that lets you estimate this in your head. Take the number 72 and divide it by your yearly return. At a 10% return, 72 divided by 10 is about 7. That means your money doubles about every 7 years. 20 becomes 40, 40 becomes 80, 80 becomes 160, and the pattern keeps repeating. But here's the part most people never hear. The first decade feels slow, painfully slow. You check the account and wonder if anything is happening at all. The growth looks small. The progress feels invisible. Then something strange happens. The later years start producing more growth than the early years combined. The last decade can add hundreds of thousands of dollars while you're doing absolutely nothing different. It almost feels unfair, but that's the secret of compound growth. The beginning tests your patience, the ending rewards it. And the people who become wealthy are usually not the ones who find a better investment. They're the ones who stay around long enough to let the math finish its job. Section 2. Now here's the exciting part. Everything we just covered was based on a single $20,000 deposit. No extra money, no monthly investing, just one decision and a lot of patience. But most people do keep earning money over time. And even small monthly contributions can act like an amplifier. Think of it like adding small pieces of wood to a campfire. The fire is already burning. Every piece you add gives it more fuel and makes it grow larger. The same thing happens with investing. Let's say you start with that same $20,000, but you also add just $100 per month. Not $100 per day, not $100 per week, just $100 per month. Over the long run, that can grow to roughly $1, $4 million. Now increase that monthly amount to $200. That small change can push the final value to around $2 million. And if you can invest $500 per month, the ending value can climb well past $3 million. Notice what changed, not the investment, not the strategy. not the amount of time spent studying charts or reading market news. The only thing that changed was the size of the automatic contribution. This is why wealth building is not a contest to find the perfect stock. It's a process of finding the highest monthly amount you can comfortably invest and then letting time do the rest. For some people, that number is $50. For others, it's $100, $200, or $500. There is no magic amount. The goal is simply to find your rung on the ladder and stay there. Because the real power does not come from making huge deposits. It comes from making small deposits again and again without thinking about them. Small, automatic, time. Those three words have created more millionaires than any market prediction ever will. And once the system is running on its own, every month becomes another quiet step toward a future version of you that will be very glad you started. Section 3, at this point, the plan sounds almost too simple. Start with money, add a little more over time. Wait, become wealthy. So if the math works so well, why don't most people end up with $1 million? The answer is important because it has nothing to do with intelligence. It has nothing to do with being good at math. And it definitely has nothing to do with predicting the stock market. Here's a surprising fact. When people talk about retirement savings, they often hear average numbers. And averages can make things look better than they really are. A few very wealthy people can pull the average way up. But when you look at the typical person, the picture changes. The typical near-retirement account balance is only a small fraction of $1 million. That means millions of people spend decades working, saving, and planning, yet still arrive far short of where they hope to be. Why? In almost every case, one of two things happened. Sometimes both. The first mistake is that they never use the right vehicle. Imagine trying to drive across the country on a bicycle. You might move forward, but you're using the wrong tool for the job. Many people save money, but they leave it sitting in places where it barely grows. They work hard to earn the money, but never put it in a system designed to build wealth. The second mistake is even more common. They get scared and leave at the worst possible moment. The market falls. The news turns negative. Everyone starts talking about disaster. Fear takes over. And after years of progress, they sell everything and step off the path right when staying put matters most. It's like planting a tree, watering it for years, and then cutting it down just before it starts producing fruit. Those two mistakes destroy more wealth than almost anything else. The good news is that both problems are completely fixable. And before this video ends, you'll see exactly how to avoid them so the math we've talked about actually works for you, not just for people in a textbook. Section 4. Now let's talk about the engine that makes this whole plan work. An index fund sounds complicated, but the idea is incredibly simple. Imagine you walk into a grocery store and buy one apple. If that apple turns out bad, you're out of luck. But what if you buy a giant basket filled with hundreds of different fruits? If one fruit goes bad, it barely matters because you own so many others. An index fund works the same way. Instead of trying to pick one winning company, you buy a basket that owns a small piece of many companies at once. Some companies will struggle, some will fail, others will grow into giants. Because you own the whole basket, you benefit from the winners without needing to guess who they will be. And here's the key idea. If you own the whole market, you cannot lose to the market. You become the market. That may sound too simple, but the evidence is surprisingly strong. For years, experts have studied how professional money managers perform compared to simple index funds. The results are not even close. Over long periods like 20 years, the overwhelming majority of professional fund managers fail to beat a basic index fund. Think about that for a moment. These are people with teams, research tools, fancy offices, and years of experience. Yet most of them still lose to a simple basket that does almost nothing. Then there is Warren Buffett. He became one of the most successful investors in history, and he made a famous bet to prove a point. He bet that a simple S&P 500 index fund would outperform a group of expensive hedge funds over time. Many experts thought the hedge funds would win. They didn't. The simple index fund came out ahead. That result shocked a lot of people, but it shouldn't have. When you stop trying to outsmart the market and simply own it, something powerful happens. You remove the guessing. You remove most of the mistakes. and you give yourself the same tool that has quietly built wealth for millions of ordinary people. Not because it is exciting, not because it makes headlines, but because it works. And as you'll see next, the hardest part of this strategy is not choosing the fund. It's having the patience to leave it alone. Section 5. There are many reasons index funds work so well, but almost all of them can be boiled down to two simple advantages. The first is structural. The second is human. Let's start with the structural advantage. Fees. Most people don't pay much attention to fees because they seem tiny. What's the difference between 0.03% and 1%? It sounds like almost nothing. But investing is a game played over decades, and small numbers have a way of becoming very large numbers. Imagine two people each start with the same $20,000. Both earn the same market return. The only difference is the fee. One uses a low-cost index fund, charging around 0.03%. The other uses an expensive active fund, charging 1%. Year after year, that extra fee quietly takes a small bite out of the account. At first, the difference is hard to notice. But over decades, those little bites add up. The result can be a gap worth hundreds of thousands of dollars. Not because one investor was smarter. Not because one picked better stocks. Simply because one kept more of what the market gave them. Now let's look at the second advantage. Human behavior. This is the bigger one. Many investors think their biggest enemy is a market crash. It isn't. Their biggest enemy is themselves. History shows that missing just a handful of the market's best days can destroy a huge portion of your long-term returns. And here's the strange part. Those best days often happen very close to the worst days. They usually show up when fear is at its highest, when the news is scary, when people are selling, when it feels safest to get out. Missing only the market's 10 best days over a lifetime can cut your final result roughly in half. Think about that. Years of saving, years of patience, and a few emotional decisions can erase a massive amount of wealth. An index fund has a special advantage here. It cannot panic. It cannot watch the news. It cannot get scared. It simply stays invested. The basket never flinches. The challenge is getting yourself to do the same. And that's where the idea of not checking starts becoming more than a habit. It becomes a financial advantage. Section 6. So what does the actual system look like? If you wanted the simplest path possible in 2026, this is the order, not the exciting order, not the order that gets clicks on social media, the order that quietly builds wealth. First, contribute enough to your 401a to get the full company match. Always start there. If your employer offers matching money, that is free money. Walking away from it is like turning down part of your paycheck. In 2026, you can contribute up to $24,500 to a 401n. Second, if you qualify, fund your HSA. An HSA is one of the most powerful accounts available because it comes with major tax advantages. In 2026, the contribution limit is $400 for an individual and $8,750 for a family. Third, max out a Roth IRA. The 2026 limit is $7,500. Fourth, go back and keep adding to your 401na until you reach the annual limit. And fifth, if you still have money left to invest, put it into a regular taxable brokerage account. That's the stack. That's the system. Notice how boring it is. Now let's talk about what you actually buy inside those accounts. You have two easy choices. Choice 1 is a target date fund. One fund, one purchase. It automatically adjusts as you get older. Choice 2 is a simple 3-fund portfolio. A US stock fund, an international stock fund, a bond fund. That's it. And now for the most important part. Look carefully at what is not on the list. No day trading, no options, no crypto, no stock picking, no chasing hot tips, no trying to predict what happens next week. The things people spend the most time talking about are missing on purpose because this system is not designed to be exciting. It is designed to work. The goal is not to beat everyone else. The goal is to become wealthy while spending as little time as possible thinking about your investments. Section 7. For a strategy this simple, there is really only one thing that can destroy it. Not a recession, not a market crash, not even a bad year. The real danger is opening the app during a crash and selling. That's it. That is the mistake that turns a future millionaire into someone who starts over again and again. Because every market crash feels different when you're living through it. When prices are falling, it never feels temporary. It feels permanent. The headlines get darker. Experts argue on television. Friends start talking about getting out. And suddenly, selling is like the safe choice. History tells a different story. In 2000, many people believed the market would never recover from the dot-com crash. In 2008, people thought the financial system itself might break. In 2020, the world seemed to stop almost overnight. Each event felt like the end. Each event created fear. Each event convinced millions of people that this time was different. And yet, every time, the market eventually recovered. Not because the problems weren't real, they were, but because business adapted, economies moved forward, and people kept building, buying, inventing, and growing. The investors who came out ahead were usually not the smartest people in the room. They were the people who stayed in the room. The ones who did not sell, the ones who kept investing, the ones who refused to let fear make the decision. And this brings us back to the title of this video. The laziest way to turn $20 even into $1 million. Most people hear the word lazy and think it means doing less work. In this case, it means something much more powerful. It means refusing to interfere. It means setting up the system and letting it run. It means understanding that your biggest advantage is not a secret stock or a special strategy. It's distance. Distance from the news. Distance from the daily swings. Distance from your own emotions. Because the discipline of not looking is not a small part of the plan. It is the plan. The less often you check, the fewer chances you have to make a costly mistake. And over a lifetime, that simple habit can be worth hundreds of thousands of dollars. Section 8 by now, you know the math works. You know the system. You know the investment. And you know the biggest mistake to avoid. But there is one more catch. A hidden catch. And for most people, this is the real reason they never reach $1 million. The money never gets invested in the first place. Not because they don't earn enough. Not because they aren't smart enough. Because the money leaks out. A bigger car payment. A larger house than they need. A new expense every time their income goes up. This is called lifestyle creep. And it happens so slowly that most people never notice it. They get a raise, then a nicer car, another raise, then a bigger monthly payment, another raise, then another subscription, another upgrade, another expense. Soon, every extra dollar is gone before it ever has a chance to grow. Imagine trying to fill a bucket with water while there are holes in the bottom. You can keep pouring more and more water into it, but the bucket never fills. That is what lifestyle creep does to wealth. The investment system we've talked about is the destination. Plugging the leaks is the road that gets you there. Because even the best investment plan cannot grow money that never gets invested. And that's why Marcus and Rosa ended up in such different places. Marcus spent 40 years watching his money. Rosa spent 40 years letting her money work. Same starting point, different behavior, different result. So here's the entire strategy in one sentence. Put your money into a simple index fund, automate your contributions, stop checking the account, and give the math time to work. That's it. Not exciting, not complicated, not something that will make headlines, but it is one of the closest things to a proven wealth-building system that ordinary people have. If you found this helpful, subscribe and join us for the next video, where we'll break down another simple financial idea that can quietly change your future without requiring more work, more stress, or more time.